All right, on today's video, we're going to be talking about 1035ing a life insurance policy, when it makes sense, when it doesn't. Obviously, this is the power of life insurance is if you have an underperforming policy or you're not happy with it, there's options. One of those options is you can just cancel your policy. Another option is you can transfer that to another life insurance company, and there's benefits to that. And to talk about those benefits and the pros and cons is a Better Wealth coach that we have, Justin Gartman. And Justin, I believe this is the first video that we have on YouTube together. And so welcome to your YouTube journey. And I'm excited to dive into videos with you. And we're just so grateful that you've been on the team and have served clients all across the country.
Yeah. Hey, Caleb. Yeah. Thanks for having me on. Excited to be on YouTube for the first time and be able to just kind of share some knowledge and hopefully people get some benefit out of this.
You know, when we were getting to know each other, this is, over a year ago, there was people that were making fun of you and saying like, you are the Google Sheet king kind of deal. And I was like, oh, that's really interesting. And then it's funny because you come to this video prepared with the Google Sheet, which I love. I think our audience will love as well because numbers matter. And you have a love for numbers. And so before we jump in, why don't we just set the stage to like, what is an ideal outcome for people watching this video? And then let's walk through this. So I'll let you take it from here.
Yeah. Thanks for that. Yeah. This Google Sheet, obviously I like to throw the numbers in there. Anyone can do it. And that's what I like is, hey, throw the numbers in there, see if it makes sense, quick math, able to do that. But yeah, what we'll be looking at today and what I'm saying is not going to be, hey, everyone should 1035 and come work with us. So I want to make that very, very clear. 1035 is not the right thing for everybody. There's plenty of people that have come to me with old policies or even new policies. And I've said, no, 1035 is not going to benefit you. Keep that policy that you have. And so that's first and foremost. However, it can be advantageous in certain situations. Either it's really not that designed well, or what we'll really look at today is policy that has a good design, but wasn't really what the person was, I would say, looking for. And so,
before we jump into that, just unpack the reason why 1035s have sometimes a bad rap is, people might have a policy, and I'll just take whole life, for example. And when you get to year 3 or 4, even if the policy wasn't designed well, you really have to be objective, and you can't look at the last couple of years as sunk costs and apply that to your equation. You really have to look forward. So you have to say, okay, with my next dollars that I'm going to be funding into a strategy, does it actually make sense to transfer, or should I maybe fund this policy or minimally fund this policy and start a new policy? But you really have to be objective and look at the pros and cons there. And that's where 1035ing gets a bad rap, because people will often say, well, this is a way for an agent to make extra commission. And that is true. There are people that promote this, I think, way too frequently because of that reason. But I have done 1035 on myself personally, and there's been many clients or people that we've served that using that framework, it's like they get to make the choice, and it's actually better long term and in the short term for them to 1035. And so I just want to set the stage on like why this is so serious. But I don't think ever done a video actually diving into the numbers, and this comes up. So without further ado, let's dive into the Google Sheet.
Yeah. So let's pull this up here. So we'll start just really by looking at first and foremost, most important thing to do is understand who is something like this for. That's the first thing that we need to look at. And so, in this right here is a 31-year-old female, has the highest health rating on all of these policies. So don't look at these numbers and say, oh wow, those are way better than mine. It's because highest health rating, which does make a big difference. Person is a stay-at-home mom and had 2 policies that the more they learned, the more they watched YouTube and did different things, kind of said, I'm not sure this is exactly what I wanted. There's maybe other options, maybe something that I can potentially make this better. And so that's what led them to us. Actually, in this case, their husband had worked and had policies with us, and they had gotten policies through other people, because I know everyone's out there watching this video, watching other videos and learning more and kind of going. So wanted to kind of spread it out and see what would work best. And so ended up coming back here to us as well. But goals, wanted to pay premiums as long as possible because, as we know, once it gets going, a policy that's 30 years old is much better than a policy that's 2 years old. So want to have that ability to fund for a long time. Wanted flexibility. There may be years where, hey, we don't want to fund up to the maximum. Want to have to fund that minimum. So wanted that to be a key component. And also higher death benefit in the later years. Wasn't so worried about early on. It's more so the later years, knowing obviously we don't know when we're going to die, but ideally live for a long time. And that's where the death benefit kind of comes into play. So Caleb, any
Justin,
questions about
I know that you have many
person we're looking at?
conversations. Oh, let's finish your thought. Sorry for interrupting.
I was just going to say, any questions about the person we're looking at here?
Yeah, it comes to paying premiums. You have conversations with people all the time. How many people like the idea and see the benefit of paying premiums ongoing versus the people that are like, hey, I don't want to pay anything after 65 because this is not like an investment. It's like if I could put $1 into a machine and get more than $1 back, like why would I ever want to stop? But not everyone necessarily gets that or resonates with that. In your conversations, how many people like the idea of paying long-term versus how many people like the idea of not having to pay after a certain age?
Yeah, I would say as of late, it feels like everyone is, because it really is the option. It's not that you have to pay that. And so they're really saying, yeah, I don't think I want to pay past age 50, 55, but if it doesn't change the policy, we can do it. Let's go ahead and leave a rider on that allows us to pay for longer. And so a lot of people I've been talking to lately see the benefit of that. Now, if you're coming and you're like, hey, I got this lump sum of money, I'm going to put it in over 10 years. And then after that, I'm not going to pay it. In certain situations, doesn't make sense to do. But in most cases, it seems like, hey, if you have the option to, because I know that's what we like. We all like options.
Yep. Love that. All right. So I'm seeing now a Google Sheet of numbers.
Yeah. So we'll dive in now to, we're going to look at, this person had 2 policies. So they're 1035ing 2 policies into 1 policy. So some of you may not know that. You can take, does it have to be 1-to-1? You can take 2 policies and 1035 it into 1, which is what we'll look at. So this is the first policy. The person got it when they were 29 years old and did a front load, as you can see here. So kind of some key notes from here. And so obviously not pulling up the illustration here, but just want to highlight some key things. Is the minimum here is $4,800. So minimum's $4,800 per year and can go up to that $12,000 a year mark right here with the way it was designed. So that's the flexibility there. Problem here is that they noticed after they kind of had it set up was they can only fund $12,000 through year 10. Yeah, it does drop some there because it has a term rider for 7 years that falls off. So death benefit drops. Term rider also falls off, and now we can't fund it as much because we're going to run into the MEC limit because our death benefit is lower. So already some key differences of you see what their goals are and what this policy is, and why this may not be necessarily the best design to it. If you just look, is this a good whole life design?
In year 12 and on, you can only fund $4,800 a year.
Yeah, correct. So after that, that's the max we can go in. And so even if you wanted to continue paying $12,000, had the means to do it, your policy is completely kind of full. We can't put any more into that. In talking to them, I think the reason this was done is, hey, fund it for this long and start a new policy, which you could do if your health enables you to. And then you're also going to be starting over now from day one where you don't have dollar for dollar access to it. And so that's what they said. I don't like that. I'd wish I could fund for longer there. But yeah, Caleb, anything that sticks out to you with this design, anything like that? Obviously, it looks like a good design, but
yeah, it's I mean, we've seen a lot worse designs come across our desk. I'll just point that out. It's like some people come to us with like no cash value in the first couple of years, and like they've been sold like a traditional, pretty trashy policy on won't say any companies or but it's just like it's pretty clear that they wanted one thing and they didn't get it. This seems like it was designed for high cash value, but the thing that was maybe not aligned with the goals of the client was the ability to pay long term and the death benefit, which the death benefit is increasing, but it may not. I would wonder if the policy that was 1035 has a higher death benefit as well.
Yeah, and that's what we'll see is that it does, and so that's kind of the advantage there. And that's what this person said. Obviously, we don't expect the people that come to us, our clients, to be experts in life insurance and understand, hey, there's different ways you can do things. So it's kind of, they looked at this and was like, oh, this is the best they can get, which may not always be the case. But that's policy number one. And also don't want it to seem like I'm just trashing this policy. This is a good policy designed for high upfront cash value. And I've designed policies and very similar to this. It just comes back to, what do you want? And is the policy going to get you closer to what you're looking for?
Right. Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
Yeah, so here, policy number 2. So had that policy for a year, decided, hey, I want to start another policy. And this one being $15,000 a year. And obviously has a $543,000 death benefit. This one is much better death benefit wise. And this one, again, it's actually age 49 is as long as what they can contribute to it. And this actually has no term rider on it at all. So kind of as we seen here, and I'm sure through other videos, we see that a term rider generally makes the policy more efficient. In this case, it definitely would have made the policy more efficient. Rather than a $4,500 minimum here, it could have had probably like a $2,900 minimum, and would have had, yes, it would have had slightly less death benefit, but maybe $40,000 death benefit being less, which to me, weighing the pros and cons, rather have more flexibility, more room for those paid up additions rather than, hey, $4,500 minimum going in there. But otherwise, still not terrible design. I believe it broke even year 7 or 8, and not bad at all. But as you look at this, any questions there, or thoughts on this design, Caleb?
The thing that I'm looking at, because this client had both these policies together, is the total minimum is over 9,300. It seems so 9,300 with the maximum ability to save up to 27,000. And so the first year cash value seems to be 66% with a death benefit that does grow. But yeah, the second policy is, I like the first one from a cash flexibility and early cash standpoint, but I understand the idea of having, both, but it still seems like at age 50 that this client can only save $4,500. Did you confirm that? Because it doesn't seem like that. It would be like you're kind of taking less money up front, but then you're also not able to save more money long term, which I think that is the flaw. And I'm seeing this for the first time. Like that would be like the big flaw that I would see, is like you almost don't get your cake and you don't get to eat it. I don't know if that made any sense, but it's like usually you get one, and it's like if I have early cash value, I might have less ability to save long term, or I have a long term ability to save, but I'm taking a little bit hit on the cash value. And this seems like you get worst of both worlds.
Yeah, and this one, that's where it says like, hey, in this one, actually, the way it was adding the length to this wouldn't have changed anything at all. So it could have still contributed for 15,000, but when it was designed with this company, you get to choose how long that term rider is, the PUA rider is on there. And at age 59 or 49, that's where it dropped off. So really no reason to not continue funding it here. But with the design, you can't. And so, yeah, like you said, not much cash value early on, can't fund it. So really not the best for what this client was looking for. And so
this client came to us with these two policies, and then you're going to show like what the 1035 option was.
Yes. Yeah. So we'll look here. This is the totals. Okay. Here's the new policy. So yeah, rather than have to look back and forth, total premiums here showing a combination of both policies, essentially $27,000 a year gives you $1.3 million. It will drop on. And then here's kind of the new design that we looked at of what we could 1035 into, and kind of explain what's what through there. So new policy design, taking into consideration everything that they were looking for. So when you come work with me or anybody else here on the Better Wealth team, it's going to be a matter of, we spend a lot of time just asking questions about, hey, what do you do? Why do you want this policy? What are your goals with this over the next 5 years? What are your goals over the next 20 years? That way we can design, because there's lots of levers we can pull, and we want to make sure we pull the right levers that get you closer to those goals. And so that's what this one does. We look here, first year premium, $115,000. And you may be wondering, well, where does all of that come from? That's going to be a combination of the cash value that is coming. So this net cash value number, it would actually be maybe slightly less than that gets brought over, plus the first year premium of $27,000. So all of that gets brought on over. Any questions regarding there? Anything think the listeners should know about that, Caleb, that I missed?
No, no questions other than the fact that it seems like year one you do take a hit in this policy versus if you just cap with the two existing policies from a cash value and death benefit standpoint.
Yeah. So that's it. It's not always going to be, especially 1035. And that's why in many cases, someone comes and I'm like, maybe this number is $20,000 less and death benefit is even $200,000 less. And it's like, hey, you're going to take a hit. This may not be the best option for you. This person in particular, though, was really looking, hey, even if we looked at a design and the cash value was even about $14,000 less than that, and they were still going to be okay with that. They kind of like that. They were more so looking long term. So again, want to reiterate, not necessarily the best idea for everybody, but in this situation, for the right circumstances, it can be. So looking long term.
Yeah, the thing I would note is that you have a lot more flexibility in the policy that you 1035. The minimum is $4,500 essentially versus $9,300. So there's from a risk management standpoint, even to funding a policy, there's flexibility there. But I'll let you continue.
Yeah. No, that's a good thing to point out. There is that thing was key to them, or they were looking at. I have to pay $9,300. So even in a worse year, that's what I have to pay. Say I can't pay the maximum, but also from an aspect of, if we pay $27,000 and we're paying a minimum of $9,300, we know that's not very much going towards the paid up additions of what we could have. And so here, paying $4,500 minimum, the majority of the policy, about a little over $22,000, is able to go towards the paid up additions, which we know is going to increase that cash value and increase that death benefit and really show the growth there. And so that was important, as well as if we look now at the next year, cash value wise, at least. So if we're looking at just kind of the next year here, age 35 cash value, you're going to have $205,000 of cash value versus $204,000. So first year you took a hit, 1 year later, we are able to make up that difference cash value wise. So that was important to them as well. I know death benefit, we are looking at $200,000 difference. And you may be thinking, what if they pass away during that year? They take a $200,000 hit to what gets passed on. That's another thing we want to make very clear. Show the numbers and say, hey, you are going to take a hit here. This person was okay with that because they know probably not going to die in that year. And so they're looking more long-term and want the growth of the policy. And you see after a couple of years in year 38, so now showing every 5 years here, now you have a $400,000 difference towards this new policy. So kind of take a hit in those couple of years and to get much better later on.
And the cash value is now becoming a little bit more significant difference. We do need to point out that we're not showing long-term apples to apples from cash flow standpoint. Like when we go all the way out to age 60, we're now, granted, you're showing a premium of only $4,500, but you have cash values of $2.1 million versus 1.5. But the cash flows are different. But that just makes our point. It's like if we were from square one designing policies straight up and comparing, it would be, I think, malpractice to be like, hey, look at this policy has more cash value, but you're putting more money in. But when you're talking about a 1035, you're literally like, you're comparing like what you currently have and the restrictions that it has versus what you want. So I just want to point out that because some people use funny math and then pretend like, oh, this policy performed $600,000 better. And it's like, that's not necessarily the case, but it did allow you to fund a policy in a way that gave you more flexibility. And oh, by the way, you do have $600,000 more of cash value at age 60 because of the parameters that you're setting up. So just want to point that out and just acknowledge that you have a lot more death benefit and cash value. And that's probably the reason why this client wanted a new policy, is to give them that flexibility.
Yeah, that was key there. And that's where this year 38, so you see it's going every 5, goes from 35 to 40, 45. I put this year 38 on here because if we come back over here and look and really at the illustration, that was the last year where you can contribute. I know it's not $12,000, but $209 off of that because that term fell off at year 7. So that's the last year where it's essentially apples to apples of, hey, I'm putting in $27,000 and $27,000 for both policies. And then after that, yes, we can't contribute as much. So this one really starts to get ahead. But in that last year where you've been putting in the same amount of premium, we still have, we get $400,000 more death benefit plus more cash value. And then after that, obviously the new one with the flexibility of being able to continue to contribute does really take off and get even further ahead. Part of that is because of, you're just putting in more money, which normally, maybe they don't want to do that. This isn't the policy for them. But for the person, like you said, that wants the ability to do that, didn't want to have to start another policy, or say they waited to that year to start another policy and their health wouldn't allow them to, they didn't want to have to take that risk. They wanted to get something now they could stay with them.
And another a true apples to apples comparison would be starting a third policy and seeing the difference and like saying, okay, if this person wanted to save this number, and the reality is with inflation, maybe this person wants to even save more in the future. But let's just take apples to apples. Now you have to start a third policy. Your minimum is going to be probably $12,000, $13,000. And it's just our point exactly is like, I will value more flexibility and the fact that I can save up to $27,000, but I have half the minimum and a greater death benefit are all those things make sense. Now I do want to point out in this policy that you designed for this person, they can't save $27,000 past 60.
Yes. Yeah. So it goes to age 56, and there's one key reason for that. So since we go back to who this person was, they are a stay-at-home mom. And so as you know, Caleb, how do you qualify for insurance? What are they kind of looking at? How much death benefit and how much you can get? Typically, it's based on
your income, your stated income.
Yeah, so typically it's based on your stated income. As a stay-at-home mom, while they have probably the most important job in the world, they don't have an income and get paid for that. So with this, we did run into the issue where they can only get as much coverage as what the husband had. And now the husband actually had a policy through Better Wealth, already had a high death benefit, couldn't really get more based on his current income. And so we had to cut it off at that age.
Love it. Well, number one, I want to just thank you for putting both policies together. I think whenever you're looking at both policies, it helps when you add those numbers and are able to see on one Google Sheet like one versus the other. So thank you. And then I also want to point out that, hey, if you're watching this, you have questions, if you want to even have us take a look at your current scenario, in most cases we'll say keep what you have and potentially start a new policy if you want, because in most cases that's going to be what makes the most sense. But there have been scenarios with especially companies that are underperforming or have not, like, you don't have the belief in the next 15, 20, 30 years that this company is going to represent my cash value and me as a policyholder well. Or there's examples of like the companies that I'm sure you were with were probably good companies, but this policy design just gives you more flexibility and, you know, gave that client just a better outcome. So Justin, is there any final thoughts that you have and anything that you would say to the person watching this from a standpoint of if they have questions or things that you learned through this process?
Yeah, I'd say if you have questions, if you already have a policy, you have questions regarding, hey, should I 1035? Just schedule a clarity call and we can go over what might be possible, and also understand generally that answer is probably going to be no. I just want to make that clear that not everyone wants to come to us in 1035. It's going to be for the right person that either one, we can look and show mathematically that, hey, yeah, this works out better for you, or the person that maybe mathematically in this, if they had just waited, started another policy, maybe mathematically they should have stayed with that. However, they didn't want to take that risk, didn't want to have to go through that. And so it may be something with what your why is might make sense to do, but that's all going to be where trust an expert to walk you through what is possible and be able to explain why they're doing what they're doing, whether that's with us, somebody else I know out there, but just it's important to make sure they know why you want what you want. Because like this person, if they had got something right the first time, that's obviously going to perform a lot better, but it didn't meet the why. And so that is a key in what we here at Better Wealth want to make sure we get right.
Yeah, the last thing I'll say is if you set up your policy with early cash, it gives you a ton of options. And there was a company that we represented, and we overfunded a lot of whole life insurance policies with this company, and this company demutualized. And I know that there were many other people that were working with that company that had different strategies. They had like 10-pay strategies where you wouldn't really have any cash value the first couple of years, but they were selling you off of like the income that you would get 20, 30 years from now. And I just remember thinking how grateful I was that the majority of our clients that we served with this company was focused on early cash value and flexibility. And while this company doesn't, like, I don't necessarily believe that this would be like, in fact, I had a policy with this company that I ended up transferring, 1035ing. And yeah, it's never like it's never a fun scenario to be like, yeah, this is like, you should never plan on a 1035, but the thought process that this is available, I didn't have to start over, and I got to transfer the tax, there was no tax consequences for transferring over. And I think those options is just another reason to where you don't have to be 100% crystal clear that this is the company, ride or die, because most of these companies that we work with are rock solid. But if something does happen that is not cool, there's options to move that. And I think those options just are another reason, like, I would rather have those options versus not. So love the fact that we're talking about this. Again, we don't do a ton of videos on this because we for the negative stigmas, and we want to be very careful. But on a channel that we're trying to elevate all things insurance and try to elevate conversations, I'm excited to dive way more into numbers, talk about pros and cons. Maybe we do another video where you had a client come that wanted a 1035 and it didn't make sense. And we talked about scenarios about that. So if you're not subscribed to this channel, please do so if you're interested in learning about life insurance and all things case studies. We have a link down below where you can schedule a clarity call. We also have a link down below where if you want to learn more about life insurance, we have what's called the Life Insurance Vault. You can check that out. And we have calculators, resources, books. Like, we're trying to be the one-stop shop for all things resources around life insurance. Justin, any final words before we land this plane?
No, thanks for having me on. It was exciting. Hopefully I'll be able to come back on, and maybe we can dive into some other numbers. I can bring a spreadsheet, and we can go even further.
We got to make a tagline. So if you're watching this, what's Justin's tagline? Is it the Google Sheet King, or can we do better than that? I think we can do better than that, but I think it might have something to do with Google Sheets, and I think you should own that with a ton of pride. All right, thank you.